Assalamualaikum warahmatullah, everyone. Welcome back to our discussion on the deposit-taking Islamic bank. We know very well that Islamic bank have inherited the highly leveraged conventional banking system. There's nothing we can do about it. Within this constraint and limitation, we need to see how can the Islamic bank be able to use al-bay' as prescribed by the Quran. Earlier, we were saying that that because of the highly leveraged system, the regulator require banks to hold enough capital against the loan they make using the borrowed fund, which is deposits. And I have shown earlier that given a loan of 100 million at a 20% risk weight, the capital requirement, the minimum capital need to be allocated by the bank is 2.1 million. So any losses arising from the exposure, the maximum amount is 2.1 million. That is covered by banking capital. So meaning that if the loss is above 2.1 million, then the bank would not be able to cover the losses, and therefore the loan need to be rejected. And this is how bank is doing their capital allocation, because the loan approval does not mean just to go through the 5 Cs or the FICO scoring, but the other requirement is to make sure that bank have enough capital to absorb losses, from the intended loan applied by the customer. So if you look at a case where the loan right now is more risky, so meaning that this is a loan without collateral, unsecured, and therefore we will accord a risk weight of 100%, higher than the one in the earlier case with collateral. So without collateral, we will see that the loan is more risky because any loss event, the losses cannot be absorbed by the collateral. So the recovery process will be more difficult, and therefore usually when the bank gave a loan without collateral, the loan rate will be raised, from, like in the previous example, RW of 20%, the loan rate may be at 5%, but then at a risk weight of 100% without collateral, then the loan rate may be raised from 5% to 10%, because that is the way how banks operate. They make money from making risky loan. So how much capital is needed to cover this exposure of 100 million? So we can use the same formulation of capital adequacy ratio. And we can see here that we have now the risk weight of 100%, and therefore we can see that the capital requirement would be 0.105 multiplied by 1.0 multiplied by 100 million. So that would be 10.5 million. So now the amount of capital needed to support the new exposure without collateral is 10.5 million, which is much higher than the earlier amount of 2.1 million when the loan is collateralized. Right? So this is how the capital charges work. So the higher the risk, the higher the capital charge, meaning that bank must be responsible, be made responsible to be prepared for the impending losses, because the loan given out is not collateralized or unsecured, and therefore the losses incurred by the bank, would be much higher. So much more capital is needed in order to ensure that this loan is a viable loan to be awarded to the prospective customer. So this is basically what a banking business is. that bank make risky loan, and by making risky loan, they have to hold more capital. By making risky loan, they will be able to charge higher profit, higher loan rate, but at the same time, they have to hold enough capital against this exposure. But that depends. It depends on how big is the bank. Again, this is a minimum capital requirement of 10.5 million. A bank are required to hold more than that, because if there is a real loss event, and the amount of money that is allocated is not sufficient, then the bank will get into trouble. So that is why, even though the minimum is 10.5 million, but the actual amount should be more than that. Inshallah, we will look into this issue later on when we use an example involving Islamic banking product. Thank you very much. I will see you again. Assalamualaikum warahmatullahi wabarakatuh.